Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome back. Thank you for tuning in. In this episode, we're talking about tracking expenses and defining your tax planning strategy. Now, I know that's really important. It's something that I personally have put a lot of attention on in the recent years is, how are we tracking our expenses? How are we optimizing the tax code? Again, there are a lot of people. I remember not too long ago, another business owner came up to me and I remember him saying to me, he's like, Brandon, I need your help. And I said, okay. He's like, can you help me so that I have a zero tax liability? He's like, I know people that don't pay any taxes. And I go, I have yet to find the way to do that. So you need to talk to a CPA. My understanding is that in most cases, we're paying taxes, but there are tax deductions, tax write-offs, expenses, and there is this tax code that we hire professionals to help us optimize. So it's really important to look at what are the deductions, how does the code work, what is the documentation we need to qualify for it, and how do we, what's applicable? So even this idea of is the commercial vehicle tax deduction applicable? And recognizing that tax codes are changing every time there's an administration change, it feels like tax codes change. So you need to stay current, you need to stay relevant. And today, we're going to break down some of those strategies so that as you prepare, you have the ability to say, hey, that's a perspective. Let me talk to my CPA about this. So I want to be crystal clear. I am not a CPA. I am not a tax specialist. I am not giving you tax advice. What I'm doing is presenting some perspectives for you to think with and then to get counsel accordingly where you may be like, hey, I heard Brandon talk about this. Is this out of context? Is this something that would be applicable? How should I do that, etc.? And so let's start with the basics related to tracking your expenses. It's so important that you track your expenses. And sometimes we don't recognize that it's the simple things like setting up separate business bank accounts, utilizing a dedicated business checking account, credit cards that are under the business, practice-related transactions. And sometimes we'll actually have multiple accounts. So for me, I have one account that's all my government payers. So all of my ERAs, all my Medicaid, all my insurance, everything goes into that bank account, inclusive of co-pays, co-insurance, etc. So that's one bank account. But then I might have a separate bank account, which is strictly non-government pay. So that might be private contracts, private pay. If you do, anything that might be non-regulated, what I classify more that private sector business could be in that other account. And I'm not talking tax IDs. I've talked about the multiple tax ID model. Right now, all I'm doing is talking about a single tax ID in which you utilize multiple bank accounts to separate income and expenses. And what you may do is you might put all of your expenses related to what I'm classifying as the insurance government funding separate so that you can see that cost analysis of what it takes to provide the services under that. Now, obviously, our staffing and all that will be different. This is more about our expenses, our supplies, things like that. So we know, hey, there are certain supplies I need in order to deliver this medical service that's going to be connected to that separate bank account. We also want to use some form of accounting software. I'm going to be honest, I'm a QuickBooks guy, but I've never used FreshBooks. I've never used, there's a tool called Herd, which is specifically designed for therapists. There's different tools that help you automate expense tracking, categorizing transactions, generating reports for tax purposes, etc. So there's a ton of different softwares out there. I just happen to be a QuickBooks guy when it comes to the accounting software because that's what works in coordination with my CPA and my financial advisors. One of the things I want you to also look at is when you're taking those expenses, it's really important that you're also taking receipts and that you're categorizing those receipts. And when you're categorizing your expenses, it's important that we break it down into IRS-friendly categories. So that could be advertising, that could be rent, that could be supplies, that could be travel, that could be utilities, as listed on the Schedule C 1040 form. Categorize monthly to avoid your year-end scramble. The other thing we want to do is we want to track our expenses monthly. So we want to reconcile your bank statements monthly to catch discrepancies. So identifying deductible expenses, monitoring cash flow. This habit of reconciliation is going to make the tax season so much easier. The other thing that a lot of you may choose to do is you may choose to hire an actual bookkeeper. If managing your finances feels overwhelming, I would recommend hiring a bookkeeper, but someone that really specializes in the industry, someone that's got healthcare experience, not just but bookkeeper that works from home part-time and whatnot. I'm talking someone with a specialty to understand categorically how to structure it. So your CPA's office might do bookkeeping. I know Accounted For has a bookkeeping solution. I know there's a lot of different solutions out there. So I'm just advising you to find the right solution for you. And I think it can be a really, really valuable resource so that you have clean books, so that when it comes to your tax planning, it's really important. So one of the things I do is every quarter I meet with my CPA accounting firm, and we go over our tax planning strategies, and we utilize forecasting and projections to plan for tax planning. So how do we prepare for tax season? First and foremost, we need to understand our tax obligations. So every year I start with, what was my last year tax percentage? So as a sole proprietor, an LLC, you're responsible. There's a self-employment tax, 15.3% of net profit, 12.4% of Social Security, 2.9% for Medicare, all those different things. You need to understand what you're governing. What are you being taxed at? 30%, 28%, 29%, whatever that number is, you need to know. And you need to know the revenue, the net revenue tied to it. And so that you can optimize certain expenses to ensure that you're in the tax bracket that you plan to be. You want to maximize the tax deductions based on compliance, but deducting legitimate business expenses, reducing taxable income. Common deductions may include office and rent and utilities, furniture, home office costs, etc. We need to organize our financial records. So we want to compile income records, 1099s from platforms or insurance providers, expenses, reports, all those different things, waiting for all of that so that you have accurate reporting. We want to choose our filing method. I'm going to be honest, if you're using like your TurboTax or one of those, I can't buy in. Hire someone that can support you, that can plan, that can really make it worthwhile, because most of you want to scale, I would assume, and part of scaling is investing. So I invest in a monthly fee for advising, for tax planning, for all these different things, because it shapes the way that I run my business. And it can shape the way you run your business. So we need a plan for our quarterly taxes. I'll be honest with you. I remember the day I didn't recognize that I had to plan for those quarterly taxes. And I was like, well, now I'm like, I don't pull any draws until I know all my taxes have been covered for the year. It's just my own way. I want to make sure that we're there. So your tax liability and dividing that into the 4 payments, really important. Set reminders to avoid your penalties on that. Sometimes you need to consider a tax extension. I don't recommend it, but some of you will. That's filing a tax extension using Form 4868, but you still have to pay your estimated taxes. So even if you file an extension, you still have to pay your estimated taxes. I want you to review your state tax requirements. A lot of you don't know, but you need to actually not just review the state you reside in, but the state that you operate in. And some of you might operate in multiple states and you don't even recognize that you need to pay certain taxable income based on services rendered in those areas. So you need to look at all of that with your CPA to make sure you understand the tax ramifications of where you're located versus where you provide services versus where your team resides, and all of the components to ensure that Uncle Sam gets what they feel they're owed. So when we're looking at tax deductions, here are some things that small business owners often overlook. And some of this may be like, Brandon, I knew this, but some of you might be like, I had no clue. So the first tax deduction, many of you don't recognize. And granted, right now we're waiting to see if it gets renewed. So when you listen or watch this podcast, this could potentially be going away or gone, but we are hoping it gets renewed. And that's our employer-provided student loan repayment assistance. This is a $5,250 tax-free deduction for each employee when we offer student loan repayment. Under the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act, it was extended by the Consolidated Appropriations Act of 2021, but employers can provide up to $5,250 per employee per year in tax-free student loan repayment assistance. Right now, it's through December 31st, 2025, I believe. This is part of a broader Section 127 Educational Assistant Program, which historically covered tuition, books, and other educational expenses. So here are some key details on this I want you to think about. Payments must be made by the employer directly to the lender, or there's certain ways that you can do it, for principal or interest on qualified education loans, and are excluded from the employee's gross income, meaning they are not subject to federal income tax or payroll taxes for that employee's money. The employers get to deduct these payments as ordinary business expenses and reduce their taxable income. Requirements: the employer must have a formal written 127 EAP that meets IRS requirements, such as not favoring highly compensated employees, etc. Some limitations: if the employer is a sole proprietor or more than 5% owner of a corporation, they are limited to receiving no more than 5% of the total benefit paid out under the EAP. So these are things that you can work with a benefits broker on, but I just want you to recognize this. Why would you rather give up $5,250 to Uncle Sam when you can give it to your employees under a pre-tax benefit? Now, you can structure this plan as a bonus. You can structure it as a payout. You can structure it in all different ways, and it's up to $5,250. So it's not just here's $5,250. It could be like, hey, every employee gets a monthly contribution of this once they've reached 3 years of employment retention with us. Now, again, make sure that you stay on top to see if this gets renewed. But if this gets renewed, this is an incredible opportunity for you to spend money in a way that you may normally have had to pay Uncle Sam. And so this is by the book, by the law. Check with your CPA, check with your advisors, but looking at how we take the money owed and put it into ways to support our business, our people, and our staff can be really beneficial. Sometimes what we may even do is we may say, hey, we have a benefit bucket. Everyone has opportunities in this bucket. And this is one of the benefits that you get to choose from is if you want, you get $15,000 in benefit contribution, and it can be used in the student loan repayment. It can be used in, you can divide it up how you want. There's many different ways to do it, and check with your tax professionals, but don't forget, this can be something that helps your employees pay down some of their biggest student debt. The next thing that often gets overlooked is the work opportunity tax credit. The WOTC incentivizes hiring employees from certain targeted groups, such as veterans, ex-felons, or individuals receiving government assistance. Now, I understand we're in healthcare and all this, but there are opportunities within our practice where we can help others out. We can take advantage of incredible skill sets and people that need work. And so it's important that you check the eligibility, check with your tax professional, but If you were able to hire employees from this designated group and certify their status using the IRS form, the 8850, within 28 days of their start date, there is a credit amount. It ranges from $1,200 to $9,600 per eligible employee, depending on the group and hours worked. So, for an example, again, don't hold me to this, but if you hired a qualified veteran, it could yield up to $9,600. Let's support our troops. Great employees. It's very interesting, but we often don't recognize that we're creating this tapestry and bringing in people of this underutilized area can be a game changer for the culture, for the business, and there's tax benefits. So this credit directly reduces federal income tax liability, making it cost effective to diversify your workforce. January 28th through the 31st, 2026, Coral Gables, Florida. Your business is on the track. Are you ready to hit top speed? The Growth Code Conference is your pit stop for 4 days of proven strategies, precision leadership tools, and a tuned-up growth plan. Leave the slow lane behind and accelerate toward your best season yet. Register now at growthcodeconference.com. Another thing is retirement plans. The startup costs are a tax credit. So small businesses that are setting up retirement plans, whether it's your 401k, your simple IRA, etc., they can claim a tax credit to offset startup costs. So in this case, the business must have 100 or fewer employees with wages. At least one highly compensated employee must participate in the plan, at least one non-highly compensated employee must participate in the plan. And the plan must be new or significantly modified to take advantage of this. The credit amount up to 50% of startup costs, capped at $5,000 per year for 3 years. Now, again, check with your tax professional, but these are things to look at. An additional credit of up to $1,000 per non-highly compensated employees for contributions to their plan. This is potentially being phased out with employees above 50. But again, most of us are smaller practices under 50. And so I find that this is something you should look at. How to claim, you need to file the 8881 form. But again, contact your tax professional. This is encouraging offering retirement benefits. So I want to talk about retirement benefits for a moment. So one of the things I recognize is that every dollar we give to someone is often a dollar spent. And as we look at the retention of our workforce, our 401ks, our retirement plans can be an opportunity to not just build retention, but to prioritize our employees' future. So when I do a 401k, I do a discretionary match. The discretionary match is based on profitability of the company, so everyone gets that opportunity. We are matching sometimes as much as dollar to dollar 100%. So it's not that 3 or 4%. It really is held to that nonprofit standard where we're rolling that in to the bucket and it's benefiting our employees. But I want to say there's 2 benefits that we're seeing. So one benefit is there's a vesting period. So in that vesting period, what that means is that they have to work for us for 5 years to be 100% vested, meaning that everything we contribute, they can't pull our portion of the contribution at 100% until they've been with us for 5 years. So it's 20, 40, 60, 80, 100. So if they leave after 3 years, they only have 60% of what we contributed. They get 100% of what they contributed. But these are ways to incentivize their retention with that vesting period. The other thing that I think is really important is I tell employees, if I give you $100,000, you're going to spend $100,000. If I give you $80,000 and you get $20,000 in 401k, that 401k is investing in your future. I am building something that you're not going to touch, and that's going to actually bring greater value than if you had the $20,000 cash in your pocket right now. The value of the dollar goes down every day, so our ability to help them invest and incentivize that retirement behavior is one of the best benefits we can do. And there's tax benefits to it because it is a pre-tax benefit in many cases if they choose. There are ways also, talk to your 401k people, talk to your retirement people. Sometimes they're going to say, take the Roth side of things, pay the taxes now versus paying it later. That really is a financial planning decision that someone more qualified should make with them. But I'm just giving you this idea because this is a benefit that I think many of you would benefit from prioritizing. So the next thing that I think has been really valuable is employer-provided childcare credit. There is a tax deduction and benefit on this. Businesses that provide childcare facilities or contribute to employees' childcare costs can claim a tax credit. So I work a lot with pediatric occupational physical speech therapy practices. I am shocked that no one has built childcare facilities in collaboration with their clinics. There is a huge opportunity. It's to offer subsidized care for your therapists would be a huge recruitment tool. There's tax benefits. And so by offering childcare services on-site or through third-party providers or subsidizing employee childcare costs, there could be a credit up to 25% of qualified childcare facility costs plus 10% of resources, referral costs capped at $150,000 per year. Again, check with your tax professional, but did you know that's around? How to claim, again, that 882 IRS form. But you should be utilizing a professional before you do that. It's supporting employees with families. It's improving work-life balance and loyalty. And my point is, there's a world where you actually go in on it with multiple clinics where you have a childcare center, and maybe it's different specialties, but this idea of let's put together a pediatric childcare credit center for all the different pediatric specialties, the neurologists, the therapists. We have one center that all of our employees get to go to. So lots of opportunity there. The next thing that you may not know about is the research and development tax credit, R&D. While not directly tied to group benefits, the R&D tax credit is valuable for small businesses innovating in their field. That could include new products, processes, software. Some of the eligibility, you need to be engaging in qualified research activities such as developing new technology or improved existing products. It can be between 13 to 20% of qualified expenses. Small businesses with little or no tax liability can apply for up to $500,000 of the credit against payroll taxes for businesses with less than $5 million in gross receipts and no more than 5 years of revenue. Again, check with your tax professional, but it's worth asking about because the R&D tax credit is something that you may see, hey, this works, this doesn't, etc. But it's encouraging innovation. And this can indirectly support your employee development and business growth as a direct result. So these are the common things that a lot of you see. And for the sake of starting, some of you are sole proprietors. So I'm going to talk about sole proprietor tax deductions first. So just because I mentioned this does not mean that it's not something that could be applicable to non-sole proprietors, but it is something that we tend to see a lot of sole proprietors take advantage of. So the home office deductions, one, what is it? Basically, if you use your home for work regularly, you could write off a portion of the rent or the mortgage interest, the property taxes, the maintenance, etc. Again, tax professional. My tax professional has a whole form, a whole algorithm based on square footage, all these different things, but it's often overlooked because many assume they don't qualify if they don't own their home or if the space isn't a separate room. Renters and those using a corner of a room, if exclusively for business, may be able to still claim it. So it's a simple method. It sounds like $5 per square foot up to 300 square feet, max $1,500 benefit, or the actual expense method is another way to do it. So work with your tax professional, but put it on your target to say, let me look and see if the home office deduction is applicable. Keep detailed records of expenses. Ensure the space is used solely for business to avoid audit risks. Very important. Business use of vehicle. So, deduct the expenses for using your car for business purposes. This could be driving to patients, driving to a secondary office, conferences, client-related errands, etc. It's often overlooked because many forget to track mileage or assume commuting qualifies. Now, I want to be clear. This typically is not driving home to the office. this is typically driving on behalf of the business from one thing to another. So from the office to a client to a conference, etc. You need to choose between the standard mileage rate or the actual expenses. The IRS standard is usually what we do. So I'm using the standard mileage rate for me, but you may have a different way. There are apps that really help with this. So Mile IQ is one that I like, and that can help you kind of track so that you're IRS compliant. Another tax deduction that some of you don't recognize is professional development and education. You can deduct the cost for continuing ed certifications, workshops, or conferences related to your practice. So there is the potential that, yes, Growth Code Conference could be a tax deduction for not just you, but your team. Plenty of opportunities there. Why it's overlooked, some assume personal growth courses don't qualify, but any training that maintains or improves the skills for your practice may be deductible. How to claim include the registration fees, the travel, the lodging, the materials on a Schedule C. So that allows you to do that. Keep your receipts and document how the training relates to your practice. Another common tax deduction is hiring your child. Did you know that you may hire your child? If you own a private practice, sole proprietorship, or LLC, you could employ your children under 18, pay them a reasonable hourly rate, deducted as a business expense. The income is tax-free for the child if they are under the standard deduction, $15,000 for 2025. Again, check with your tax professional. Many don't realize they can shift income to a lower tax bracket with their child, or that strategy is IRS compliant. So you have to structure it compliantly, but it's really important, and you need to pay your child for legitimate work. That could be social media, cleaning the clinic, filing, following up on things, etc. Now, you need to treat your employee like you would any other employee. So that means HIPAA certified, all the different things, all the different trainings. It's just there is that opportunity as long as you don't exceed any regulations. And so invest the child's earning into a Roth IRA for a tax-free growth as their income qualifies them to contribute. That could be a tip to expanding how you optimize not just your tax deduction, but the benefit it brings to them in helping your business. So there's obviously a self-employment tax deduction if you're a sole proprietor. So you can deduct half of your self-employment tax when calculating adjusted gross income. It's often overlooked because many don't realize how that works with self-employed individuals. I want to be clear, there's a lot of sole proprietors that write off everything and don't pay taxes, and they will get dinged. It's not a matter of if, it's when. There's a lot that people don't recognize because they're so small that if one day they do get flagged, they could be in deep, deep trouble. So another thing is health insurance premiums, deducting health insurance premiums for yourself, your team, your dependents, your spouse. If you're self-employed, looking at that whole piece, just knowing that you would report it on a 1040 Schedule 1. So what those premiums are, taxable income, etc. You may also combine it with an HSA for additional deductions. Retirement plan, again, even if you're a sole proprietor, you could look at doing like a SEP IRA, simple IRA, different things like that, solo 401k. There's different ways for you to look at that as well. Startup costs, this is another common deduction. So a lot of times we can write off some of these startup costs. Often overlooked business expenses, tax preparation fees, business meals, renting your home to your business. So sometimes you'll rent your home to your practice for business purposes, like a photo shoot, a meeting, or whatnot. Like I know someone that actually puts on workshops, and they have a condo that they just use for that, and they rent it out. So they rent out the actual condo to the business. Different ways for you to do that. There are stipulations, so make sure you understand what is deductible, what is not, and the max available for that. Employee benefits, advertising, marketing, professional licenses and subscriptions. These are all business expenses that can be part of that equation. Did you know in 2025, the Medical Economics Physician Report estimated that practices with proactive tax planning save 18% on tax liabilities, reducing financial stress for 50% of owners? There's a huge opportunity here. And so everything that we've covered today, I want you to make a list of anything that you're not doing, and I want you to meet with your tax professional. I want you to bring these strategies to them. And even things like FSAs and HSAs and all these different benefits. So I'm a big believer that if you don't offer a flexible spending account deduction for your employees, you're missing out. That's a benefit to them. It's a benefit to you. There are many different ways to structure benefits as deductions. There are many different things that we don't recognize are business expenses that are justified. So working towards understanding the tax code and the ways that you collect your receipts, the way that you categorize your expenses, and the ways you budget for that is really important. The last thing I want to share with you that some of you don't recognize is that you're like, hey, Brandon, but I'm doing all these tax deductions, but now my business isn't looking as profitable. And I say sometimes there's ownership benefits that are tax deductions. And later when we put a value on your company, we do what is called an add back. And that add back is something that we can say this will no longer be applicable when we sell the business. And that's an add back to the profitability of the practice. And that's things like sometimes it is commercial vehicle. Sometimes it's different benefits in those senses. And so don't be afraid if your tax-based profitability looks worse, as long as you're compliant, but you can say, hey, these are tax deductions we get that are an owner's benefit, et cetera. And just making sure you structure it right is really critical. So in the words of Benjamin Franklin, beware of little expenses. A small leak will sink a great ship. And I think that's really important. I'm going to say it again. Benjamin Franklin said this, beware of little expenses. A small leak will sink a great ship. Sometimes it's the little things that we miss that bring our private practice and vehicle of change down and underwater. Thank you for tuning in to the Private Practice Survival Guide podcast. Don't forget to like us, subscribe, write a review, share us, and be part of this journey. Together, we can thrive, not just survive. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you loved this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.